Intel just reported its 2022 Q4 earnings, and oh boy were the results ugly. Adjusted earnings per share came in at only 10 cents per share. This missed the already low analyst expectations of 20 cents per share. That is Intel's worst quarter since 2009. Revenue came in at $14.4 billion, missing analyst expectations of $14.45 billion. Q4 revenue is down 32% year over year. On top of this, the company issued grim 2023 Q1 guidance. Intel is forecasting continued declines with revenue of $10.5 billion to $11.5 billion. Also expecting GAAP EPS of negative 80 cents and adjusted EPS of negative 15 cents. Not good. All this news caused Intel stock to fall nearly 10% after hours. Today, I'm going to analyze Intel's latest earnings report, explain what they announced about their dividend payment, and share my thoughts as an Intel shareholder. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Going into this quarter, poor performance was the expectation. However, they managed to fall below that low bar. Intel's financial performance has been declining quarter after quarter throughout 2022. This is as the PC market weakened, chip shortage ended, and oversupply started in some of Intel's biggest segments. On top of this, macroeconomic conditions have worsened. This is a recipe for poor economic performance. At the same time, Intel is investing massive sums of money in growing future manufacturing capacity. Overall, semiconductor demand is expected to double over the next decade. Additionally, Intel is under a business transformation to open up their manufacturing for other chip designers. The goal is to grow a foundry business model similar to Taiwan Semiconductor. If successful, that would set up Intel in a much stronger business model. That is a multi-year journey though. It also happens to be a horrific time to be spending massive amounts while you're earning less than ever. In 2022, Intel had negative $4 billion in adjusted free cash flow. This is off of a total of $15.4 billion in cash from operations. They saw improvements in Q4 with $7.7 billion in cash from operations and $3.06 billion in adjusted free cash flow. That is a good sign that they're trying to manage cost. While listening to the earnings call, management mentioned that they were planning to be free cash flow neutral in 2023. However, with the weak environment, it's likely they will be negative again. With Intel, their largest business segments are all declining year over year. Client Computing Group, which is their PC business, is down 36% year over year for Q4 and 23% for the full year 2022. This segment is the worst impacted, and the weakness will continue into 2023. The PC market is terrible right now. The overall PC market saw 28.1% sales drop in Q4, the worst change ever seen. One major factor here is the work from home demand in 2020 and 2021. These are very hard comparables to match. Think of all the different companies which got laptops for their employees to work from home. Combine that with every school that bought laptops. My sister is a teacher, and she mentioned to me that now every single kid in school is supplied a laptop. Think of the massive difference that is from the 1 or 2 carts they used to have for the whole school. Consumers bought PCs at record rates in 2020 and 2021, but declined to upgrade those relatively new PCs in 2022. That trend is expected to continue for at least the first half of 2023. Analysts are expecting the PC market to recover in late 2023 to 2024. On Microsoft's earnings call, they said to expect, quote, PC market weakness for the foreseeable future. Luckily for Microsoft, that is an important business segment, but one of their smallest. For Intel, it's the exact opposite. However, this is not the end of the world. It's important to zoom out and think longer term here. On Microsoft's call, CEO Satya Nadella highlighted that usage intensity of Windows continues to be higher than pre-pandemic, with time spent per PC up nearly 10%. What this means is the total addressable market and demand for PCs has still grown overall. It may take time for that upgrade cycle to be realized again in PC sales. Intel's second largest segment, data center and AI, is down 33% for Q4 year over year and 15% for the full year fiscal 2022 compared to 2021. One positive sign is that unlike client computing, the data center did not decrease more from Q3. It actually grew $100 million. On the earnings call, Intel CEO Pat Gelsinger mentioned that despite despite competitors fighting for market share and new products sold, it's important to remember that Intel has near 95% server market share in total active products. Gelsinger argued that this consumer relationship, along with improved product offerings, will lead Intel to continued data center strength. Also, he mentioned that they have a strong product roadmap and data center rolling out over the next year. Long term, the data center will likely be a growth driver for Intel. So given all this news, what am I doing with my Intel stock? The 2023 outlook is incredibly poor. If I was looking for a short-term trade, I would not be buying Intel right now. However, as a long-term holding, it is appealing. My decision for holding my Intel shares through this financial pain is based on the dividend. The company just declared their quarterly dividend, keeping it in line with the previous amount. On the earnings call, the CFO stated that the board is very disciplined with capital allocation and are committed to retaining a competitive dividend. You might ask, how can they do this when losing money next quarter? Well, the same way oil companies do when prices are unprofitable. They use the balance sheet to support the dividend in times of pain. Intel has $23 billion in cash on hand and a reasonable relationship with debt. If needed, they could easily support the dividend until the business becomes profitable again. If Intel cuts the dividend, then I will choose to sell the stock. I'm not going to wait for that multi-year turnaround if there's no dividend to hold me over. There are many other market opportunities available. In the meantime, I'll get close to a 5% dividend yield and wait for the long-term strategic plan to play out. This will take many years. However, if executed, the current valuation could lead to fantastic returns. In my opinion, the bull case relies on Intel's ability to grow their foundry service business. That could be the golden goose. It's possible that over 5 to 10 years, that business could grow to rival their client computing and data center segments. Under that situation, Intel would be a steal at current prices. That said, this is all just my opinion, and you should do your own research before making any financial decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to use my stock research software and join a Discord community of like-minded investors. A lot of us were discussing this Intel news live in my Discord. Follow me on Twitter for all my latest stock buys and dividends coming in. Thanks for watching.